We have two major things to discuss on this video. I'm going to share the screen. Guys, US loses last AAA credit rating. Moody's downgrades the US government, citing large fiscal deficits and rising interest costs. On our main channel, on this channel, we have discussed that, yes, the US is a very safe place right now for money. But you've got to remember that just like everything in life, if you do something simple to an extreme, it might have bad repercussions. Maybe not today, maybe not tomorrow. We don't know when. But if the US continues with these deficits, they will need to print more money, which would mean more debt, which would mean more downgrades to our debt level. Expanding budget deficits mean the US government borrowing will rise at an accelerating rate, pushing interest rates up over the long term. As we've discussed, as we borrow more, it decreases our credit worthiness. If our credit worthiness is lower and lower, we have to increase how much we pay other countries for that risk, or other people who own the debt for that risk. The move strips the US of its last remaining AAA credit rating from a major ratings firm, following similar cuts by Fitch in 2023 and S&P Global in 2011. Moody's downgraded the US to AA1, a rating also held by Austria and Finland. Keep in mind, this is still fine. But the point is, the thought AAA credit rating going to AA1 happening was still not even a thought 25 years ago. But we've greatly extended our balance sheet. We've greatly expanded our deficits. We've greatly expanded our debt. There's only one way out of this: decreasing that deficit. Guys, they should be able to do a surplus here. Second thing that happened today: consumer sentiment slides to the second lowest on record as inflation expectations jump after tariffs. One thing to keep in mind, though, the majority of the survey was completed before the US and China announced a 90-day pause in most tariffs between the two countries, which was, I believe, on Monday. The trade situation appears to be a key factor weighing on consumer sentiment. Now, remember, consumer sentiment is forward-looking, but people are reacting to what they feel right now based on recent events. The outlook for price changes also moved in the wrong direction. Year ahead, inflation expectations rose to 7.3% from 6.5% last month, while long-term inflation expectations ticked up to 4.6% from 4.4%. However, the majority of the survey again was completed before US and China. Inflation expectations are closely watched by investors and policymakers, but what we talk about is inflation will be what it is. The main goal for anybody who's investing is dollar cost average and low cost ETFs. It'll allow you to buy when people are scared shitless, and you'll buy when people are euphoric, but you'll pay the market average. You will match the market over time. And if you're buying individual stocks, these factors should not affect you, because a well-run business will do well during good times and bad times. A poorly run business only does well during good times. A business that's built on momentum will only do well when momentum is high. But if you buy good companies with great balance sheets and you pay the right price, you will do well, and you'll get an opportunity when everybody has fear and dropping those companies and selling the stocks. Now remember, people are investing a lot in ETFs. A lot of my friends who are younger, when I talked to them, just one today said he liked Estee Lauder. And I texted him. He texted me about Estee Lauder a while back. And I said, hey, did you see Michael Burry? He bought Estee Lauder. He's like, oh, that's sweet. He goes, no, I like it, and I have a few shares, but vast majority of my money goes to low-cost ETFs, and I was really happy about that. Everybody's doing it. 25, 30 years ago, when I started investing, low-cost ETFs were not a major thing. That was not the main thing out there. You bought actively managed mutual funds or individual stocks. When people are buying these ETFs, it forces these ETF companies to go buy more shares in the S&P and the companies within their ETF. So it can drive prices up to levels that we haven't seen before. Our valuation levels are still high. But you couple these things together, who knows what the future holds. This is not about Fudster. We're trying to let you realize. We're not trying to put fear, uncertainty, and doubt. We're trying to let you realize that cycles are a guarantee in life, just like death and taxes. You've got to be ready for cycles. We want you to be the opportunistic person during cycles. We want you to be the person who goes, markets go down, I get more of what I want for cheaper. Even though the news out there will be awful news, because news follows the stock price. With that in mind, guys, I appreciate you watching this video, and good luck to you. Thank you for your time.